It's 25 years since the stock market crash of 1987. October 19th, the day we still call Black Monday. The Dow Jones Industrial Average fell more in a single day than it had ever fallen before or since. It took the whole of Black Monday for the Dow to fall 23%, as brokers at the New York Stock Exchange looked in vain for buyers at lower and lower prices. In today's high-speed markets, what took a day then might take just moments. 2012 has been the year of computer glitches. They spoilt the IPOs of Facebook and the exchange group Bats, and a single bad line of computer code cost one of the largest trading firms, Knight Capital, $440 million in 45 minutes of manic trading. Investors are still reeling from the flash crash 2 years ago, when a chain reaction among electronic traders sent stocks down 9% in minutes.
What we're losing in this marketplace today is the long-term investor.
Ken Polcari's been on the floor of the New York Stock Exchange since 1980. He's worried that investors are losing patience with the stock market.
It goes up 300, down 200, up 500. People don't understand it. The market never did that before. So the person that's not in this industry, that might be a doctor or a dentist or a lawyer that's trying to save money for their kids' education or save money for their future retirement, and they see the market react like this, and they see automated meltdowns, it causes them to say, what's happening? I don't understand it, so therefore, I'm going to take my ball and I'm going to go to a different court.
What links this year's glitches is that one way or another, they're all the result of a technological arms race. The monopolies that the New York Stock Exchange and NASDAQ enjoyed 25 years ago are long gone. There are more than 50 trading venues now, and the competition has undoubtedly reduced trading costs for investors. But knitting this increasingly fragmented system together requires increasingly complicated computer software. Many of the upgrades that went wrong this year were designed to handle the increased amount of data flowing through the system. Mary Shapiro, the SEC chairman, spoke at an industry roundtable to discuss the disaster at Knight Capital.
This type of problem, as with the IPO mishaps, was again the result of basic technology 101 issues. Events like these demonstrate that core infrastructure and technology issues can be problematic in any market structure.
Nevertheless, the structure of the US equity market is now a major topic of conversation in the industry. So is Regulation National Market System, or Reg NMS, the set of rules the SEC introduced 5 years ago to regulate how customer orders must be treated in the current fragmented system.
And it's accomplished a great deal of what it set out to accomplish. The amount of liquidity available in the market is much higher, spreads are much tighter, so I think in a lot of ways there's some resounding success. However, at the same time, are there unintended consequences of the rule that we might want to look at now? The competition between the marketplaces has been a great boon, but maybe you can make the argument that there's maybe too many marketplaces, and undue fragmentation might have been an unintended side effect. So
I think what we really have to understand, and when I say we, I don't mean just regulators, I mean regulators, industry, everybody, is that perception is important. Perception for many people, can sometimes be reality, and so it's really important to be on the side of ensuring that we explain to investors why they can have confidence in our marketplace and constantly demonstrate that commitment to ensuring the markets remain fair and safe.
What frightens investors most is a sudden evaporation of liquidity when everyone pulls back from trading at once. That was always the accusation against the human traders of yesterday, but as the flash crash proved, the machines can and do back away if markets are disrupted. The frequency of the software glitches this year is making people nervous.
My fear is that they're not over. My fear is that you fix it here, but then there's something that just gets undone over here. Because I'll be perfectly honest with you, the Knight debacle was the result of one line of code that was wrong. One line of the millions of lines of code, one line was wrong. Think about it. And think about today, the number of people that connect into the financial system. So my fear is that you could have another event that we don't know what we don't know, right? You don't know what you're looking for, so you don't know what that event is.
The transformation of the market since 1987 has delivered cheaper trading costs and faster execution for investors. But it's delivered dizzying complexity too. Now investors worry that the world's largest equity market might be just one glitch away from a computer-generated maelstrom. Stephen Foley, Financial Times, New York.